Ladies and gentlemen, welcome to my first episode of what I'm going to call the Pace of the Markets. My name is Dan Pace and I do stock investing, and in this video I'm going to take you through a couple of major macroeconomic trends I see going on in the stock markets and hopefully help you out with a few ideas of what to do with your money. I'm of course not an advisor. I do not want to take any responsibility at all for what happens. I'm going to just try to tell you what I see, what I'm doing, and as a result, I do probably hold positions in, these indexes or these, trades. Just getting that disclosure out of the way. So the date is February 11th of 2020, and the S&P 500, as of the close of today, is at 3,357.75 points. I use the S&P 500 to track the economy, mostly because it's a scale of 500 stocks as opposed to the Dow, which only measures 30, which is actually a pretty small portion of the almost 5,000 major public companies that are out there, so 30 sucks. And as of the moment, I do think the markets are good, which kind of translates to you should have most of your money invested and not really hedged too much, if at all. However, it's good-ish because it's been good for quite some time, and the things that are making it good are about to run out. So let me take you to a whiteboard I've drawn up to explain these a little more in detail, and I'll go through that. Well, for future videos, I probably won't be using the whiteboard. I'm not a huge fan of it for this video, but since it's the first one, I'm just going to kind of get through it. Oh well. The major things going on with the stock markets right around now is that there is an excess of liquidity thanks to the Fed. I'm going to get into that in just a moment. There are record highs. That means there's lots of support areas to the bottom as if things were to start dropping, and there's no resistance going upwards since we're in uncharted territories. And the major detrimental thing we have going on right now is the coronavirus, which does affect the oil demand and shipping, which affects just about everything in the economy. So let me just go back into liquidity just for a quick moment. Quantitative easing was happening in 2008, 2009. Back before the Fed had stepped in, typically banks and investors and hedge funds would buy long-term bonds from other banks and the Treasury in exchange for cash. These banks and Treasury could use that cash to run the country or put out loans, do day-to-day things. The Fed had to step in and give cash basically to the banks and Treasury and support this market in order to keep everything running and support liquidity, which led markets to go up from the lows of 2008, 2009, which, if you do remember, was a pretty major financial crisis. So it was a major boost to the markets. What's going on right now is that the Fed is stepping into these markets called the repo markets here. That is essentially the exact same thing, except with short-term bonds. So banks and treasuries typically trade short-term bonds with other banks, investors, and hedge funds for cash that they can use for short-term expenditures, have some cash to hold overnight or to give out to lenders for a short-term loan. And this market had weakened around October and September, and again the Fed had stepped in to support this market. So now the Fed, with pretty much their unlimited bank account, is buying those short-term bonds from the banks and treasuries and giving them enough cash to keep their business running and keep the banks running. So what ends up happening though right now is that these banks, investors, and hedge funds that otherwise would have had to use their cash to support this market are now able to put their money into the stock market. This is what leads to having liquidity in that market. Now what liquidity really means in this situation is that as stocks drop, there's always money available to buy them. And as people want to sell stocks, there's always money available to sell that too. So essentially what this means is that if you want to sell a lot of stocks, there's a lot of money there ready to buy it. So it's hard for the markets to go down with that much liquidity in the markets from the Fed's unlimited bank account. Now, the Fed has said this will keep going on until about June, so around May is probably when I would say this sort of trade has gone stale, which is also why I think the market's a good-ish, not so much just good, because May is just around the corner. It's only a few months away. So next, I also did mention record highs, so let me take you to a chart on my computer to kind of explain that a little bit to you. So here we are with a chart of the SP 500, and it is at new highs, which, as I said, to the upside here, we don't really know where we could stop, so there's no resistance heading up. And as we go down, there are several areas that have kind of marked themselves off as support. First of these being about 3,300, the next about 3,250 around here, then 3,100, and then 3,000. So those areas are where we had dropped to previously, and the market had came back, and people bought that back up. So right around here, we hit this and got bought up. Before, around the coronavirus introduction, we hit this and market bought it right back up. Around here, bought it right back up. And 3,000 was about when the China trade deal was, part one of the China trade deal was finalized. And markets have, as you can kind of see in this other chart, markets have friggin' skyrocketed since we passed that 3,000 mark. So that does bode well for the economy as a whole. And as we hit these support lines here, they might in the future signal that the market isn't as good as it was before. So at that point, I would probably make another video and things would change, which they always do. Nothing is constant. That's just what stocks are. So the major negative that's going on in the economy right now is essentially only the coronavirus. But the investors out there don't seem to be too worried about that. Just like other viruses in the past, like Ebola, SARS, the avian flu, the infections of them were mostly contained, and within a relatively short amount of time, it was dealt with, and infections of it went down. And it never became a global epidemic. And there's not much of a reason to expect the new coronavirus to not do the exact same. However, at the moment, China is pretty much locked down, and the last week they've been locked down, meaning their production has practically been cut down to zero. China is the second largest economy in the globe. So since the second largest economy in the globe isn't doing any production, that is a major hit to the growth of every other nation that does business with China, which does include the US, as well as Saudi Arabia and all the oil producing companies as well. So that's the major drawdown right now. Oil demand has taken a huge hit from China being on lockdown, as well as shipping companies and transportation companies, as well as manufacturing companies and materials such as steel, copper, lumber. All of these commodities and companies have taken a huge hit in demand. It has dropped, which does typically lead to less revenues, less profits. So there should be a drop in their valuations. However, like I said, most people think it's going to be a temporary drop, and investors are not worried too much about the present day situation. They're always looking forward for what's going to happen in the future. So as a result, commodities have taken a hit and seem to be holding downwards, but companies, which are more further future based, are doing okay. And again, the coronavirus is sort of adding to why I call the market right now good-ish. If things don't start coming back up and running not very soon, but soonish, we could actually start seeing a drop in valuations in the stock market and the companies within it. That's something I'm keeping a close eye on. That's also something the Fed has said they are keeping a close eye on as well, which also is helping markets go up too, since if it does start to affect global economies as well as the United States economy with the SP500, the Fed is possibly and very likely to step in and give even more liquidity, more rate cuts, more stimulus to keep the economy growing and soaring, keep jobs coming up, growing, soaring, and just keep the party going, really. And all in all, that's essentially what I'm seeing in the macroeconomic trends. I do want to also include in these videos, if I can, of course it's not a guarantee that I'm always going to have some trade, I'm not going to make up some bullshit, but I do want to include a top trade, and that top trade is, I hate to say it, but it's Bitcoin. I do want to really say, I'm not a Bitcoin freak. I don't believe that Bitcoin is going to be the new world currency. I do believe in the US dollar. I don't think things are about to be Armageddon and Bitcoin is just going to take over the freaking world, man. No. I do know this, though. Bitcoin has held value for several years now. People can buy and sell in it. People can trade dollars for it. People can trade products for it. It is a usable currency, albeit a little slow with a couple of other drawbacks, but it does have value. It is a real thing. It fucking exists. What's going on in Bitcoin right now is that the supply rate, the rate of supply that gets added into the economy, I guess you could call it, the Bitcoin economy, is about to get cut in half. So every block that's mined, which happens every couple of minutes, introduces about 12 Bitcoin into the Bitcoin economy. Around May, that'll cut in half. So the best way I think to value Bitcoin is just like most other commodities, just like oil. So when oil production is cut, oil prices shoot up, as long as the demand stays the same, which typically it does. So if you cut the production of oil, the prices shoot up. You cut the production of how much gold is getting mined, prices will shoot up. So what do you think will happen when you cut the production of Bitcoin getting mined? Prices should shoot up. The most recent oil production cut that we have seen was about when Saudi Arabia, I believe, was attacked, and they had turned off a good amount of pumps that supplied about, I think it was 5% of the rate of production for oil, and oil prices overnight shot up 10%. So with Bitcoin, they're about to cut 50% of the production. So that's tenfold of what happened to Saudi Arabia and the oil supply. So I could only expect that the prices of Bitcoin should shoot up at least 100. At least. And as we've seen in the last years, when Bitcoin starts shooting up, there's a lot of FOMO that kicks in, and a lot of other just mumbo jumbo that leads to prices way higher than 100% gain. But at least at the 100%, you can put in an investment, take it out, half of it, and then let the rest ride for whatever happens with the roller coaster of Bitcoin afterwards. So what I am doing right now is up to about maybe 12,500 Bitcoin. I could still recommending buying it. After that, you're going to be playing a little bit of a risky game as far as how high and how fast it will go up. But I do know one thing. As that production cut gets closer and closer to Bitcoin's halving in May, prices really should rise. So that is my top trade. And like I said, I'm not a huge Bitcoin fanatic freak, but that's what's going on, and that's the truth. And people should take advantage of it, because it's not that often that such surefire trades really show up and people can actually grab them like that. So that about does it for this little segment of the pace of the markets, and I'll see you next time when some changes in economic trends happen, so I can talk about those. And I'll have the price of the S&P 500 up on that one, so we can kind of compare it to where it was at today and see if I was necessarily right to tell you that the market is in good shape and that you should be invested right now. Just with like I said, the market is good-ish. Be sort of ready to sell, ready for a change, but don't not be invested. Don't be scared. The market is actually in pretty good shape. And with that, I'll leave you. Until next time, happy trading.